All right, Federal Reserve, sick and tired of being blamed for high oil prices. And Ben Bernanke is not afraid to tell you why. Senior economics reporter Steve Liesman, who probably wishes he was outside on that stage, is here instead to talk about Big Ben.
Dancing in the streets,
That's
Aaron,
right.
is what I wish I were doing. But, you know, among the culprits for sky-high oil prices, that include OPEC, the nation's lousy energy policies, and, of course, that insatiable appetite for oil and gas. Some economists have fingered the Fed's decision to lower interest rates in response to the credit crunch. Exhibit number one for the prosecution of the Fed: oil prices up 83% since the Fed started lowering its funds rate in August 07, ultimately by 3.25 percentage points. You can see that they took off downward when oil prices headed higher. Fed officials tell me they're concerned about the inflationary impacts of their policies, but they say the evidence shows they're not to blame. Exhibit number one for the Fed's defense: the price of oil in other currencies. Over the past 5 years, oil is up 337% in dollar terms, but it's up nearly 230% if priced in euros and 290% if priced in yen. Fed officials say if it was bad Fed, as in dollar policy, then oil would not have risen as much in other currencies as well. The Fed says high oil prices have been brought on by a rise in global demand, and some don't rule out the role of speculation as investors flee, at least for now, for the relative safety of hard goods amid the credit crunch. Yet officials say when there's a relative price change in one good versus another, their main task is to counteract what they call the second-order inflationary effects. In this case, that's the pass-along of high energy and food prices into other prices. Most believe a weak economy is going to do most of the hard work for them, and they've had some reasonably good news in the form of tame core inflation in the past several months. But Fed officials make no secret the decision to hold rates steady is partly the result of their rising inflation concerns, and that they're prepared to act if inflation gets out of control. Back to you, Mark, dancing in the streets.
All right. Thank you very much, Steve Liesman. Let's bring another voice into the mix. Joining us from Toronto, Paul Van Eeden, president of Cranberry Capital. Paul, is it the Fed's fault?
Yes, Mark, but you know, I'm not looking at the very short-term rise in the price of oil, but let's look at it from a different angle. If you look at the exchange rate between the dollar and the currencies that comprise the euro, you'll notice that in 1970, those currencies were 45% lower versus the dollar than what they are now. And that means that in equivalent terms in Europe, oil is currently trading for $72 equivalents versus 130 what Americans are paying. And if you then adjust that just by the official government CPI, which in 1970 was 82% lower than what it is today, then oil today would have been $13 a barrel if it wasn't for the increase in the money supply since 1970. So oil went from $3 in 1970 to $13 for market reasons or other reasons, but it's $130. So 90% of the rise in the price of oil is merely the expansion of the money supply, which is, by the way, under the control of the Fed. So I would say that 90% or more of the rise in the oil price in the last 38 years is squarely on the shoulders of the Fed.
It has nothing to do with all the demand in the developing world?
Well, certainly it has. You know, there's still the difference between 3 and 13 to explain, and there are various ways of looking at that, but a portion of that is demand.
I'm sorry, then I must have misunderstood. I thought you were saying the difference between 13 and 130 was entirely because of the increase in the money supply.
Correct. The difference between 13 and 130 is, but the difference between $3, which is what oil was, and $13 has to do with the measure of inflation, or the measure of money supply, and a demand component, a demand and supply component, if you will.
Steve, it does seem a bit aggressive to put all of that blame from 13 to 130 on Alan Greenspan, Paul Volcker, I guess, and Ben Bernanke.
Yeah, you'd have to, if I'm not mistaken, Paul, are you saying that there should have been no increase in money supply, that none of the increase in money supply was justified over that period of time? Doesn't the money supply have to increase as the economy grows in size?
Steve, I disagree with that. You know, most economists do believe that the money supply has to increase as the economy grows. But let's just consider what would happen if the money supply did not increase. Well, if the money supply did not increase as the economy grew, then any productivity gains that were manifest in the economy would cause prices to decline. And therefore, the lower or the smaller amount of money in circulation would just go a longer way. In other words, your money would buy more goods and services. And the idea that the expansion of the money supply increases the price of goods and services in that currency is not something that I came up with.
Right.
I mean, that is standard knowledge.
But Paul, how do you justify this idea that at least over the past 5 years that you've had a not quite as big but a pretty large rise in euros and a rise in yen, and we know that the ECB is the one out there as the hard money guys. They're the ones who have held the line at 4%, and they're saying no rate cuts this year, so they're not really projecting any soft money out there. How do you explain that?
Well, the rise in the oil price from 2003 until now is very dramatic, and even on an inflation-adjusted basis, it's very dramatic. And there are two components, or perhaps even three components to that. One is the fact that the oil price during most of the 1980s and 1990s was trading flat while there was expansion of the money supply. In other words, the oil price was lagging inflation, if you will. That's one component. The second component is the fact that not just in the United States, but also in Europe, we've had a tremendous increase in monetary inflation over the past 5 years. So that contributes to the rise in the oil price. And then the third component is the fact that, hey, we may be over peak oil. And yes, there may be additional demand coming from China and India and those places which are having an impact. And all three of those are contributing to the rise in the oil price.
One problem with that argument is that it hasn't shown up in the inflation numbers that are out there in the government statistics. You haven't had the kind of inflation that you would you would expect if you're talking about the monetary aggregates being as out of whack. And I have to say, Paul, just for the viewers, I appreciate what you're saying, but in general, most Fed economists and Wall Street economists have thrown out this idea of following these big M aggregates as a way to curtail or to fine-tune monetary policy, because basically what they've concluded is it doesn't work. And well, I think that needs to be said, Paul, in response to your arguments.
You're fine to say it, but consider this, that if you look at the headline inflation versus the core inflation, you'll notice that for a long time now, headline inflation is pulling away from core inflation. And the reason for that is merely that hedonic adjustment and geometric averaging doesn't impact things like food, water, and oil. And so you have to start asking yourself about these official government statistics when, in fact, things like oil and food are not conforming to the hedonic and geometric adjustments. And the second thing with regards to monetary policy is that Alan Greenspan said that the Fed abandoned M1 and M2 because they found that it wasn't predictive for their purposes. But according to Greenspan, they never used M3. Now, I find it very interesting that Murray Rothbard created an index or an aggregate called TMS. And since 1980, TMS, which stands for True Money Supply, has increased by a compound annual increase of 6.8%, which is identical to the annual compound increase in M3. So there is something to these monetary aggregates. And the fact that the Fed don't want to use it, well, that's their decision.
All right, we got to leave it there. We thank you very much.